In this clip we're going to examine the various appraisal rules that are used in capital budgeting. So far what we've done is to examine in great detail the concept of net present value. And I'm going to argue that net present value is the appraisal rule that we should use, period. However, in the practice of finance, there's a number of other appraisal rules that are popular. So we need to understand the advantages and disadvantages of these different rules. Now it's clear in all of the examples that we've gone through that the net present value provides a way to evaluate what a project is worth using this intuition of a replicating portfolio. So we can construct another portfolio with assets that are freely traded in the market today that exactly mimics the cash flows of the project that we're going to try to investigate. And the value of the portfolio of mimicking securities must equal the value of the project by the principle of no arbitrage. This makes sound economic sense. However, there's a number of other metrics that are used to do project evaluation. Perhaps the most common metric is the idea of internal rate of return of the project. Now, internal rate of return is sometimes called the yield to maturity, and it has some other names also. But basically, the way that you calculate the internal rate of return is the following. That you take the cash flows of the project, and then you've got an initial cost of the project. You find the discount rate that exactly makes the present value of all of the cash flows exactly equal to the initial cost. This is the internal rate of return. Now we also do the same thing in bond valuation, and there we call it the yield to maturity. So imagine that we've got the price of a bond, and suppose this bond is trading for $92 today, and suppose it has an 8% coupon rate and it's got 20 years to maturity. Now suppose the coupon is paid on an annual basis. The question is, what is the yield to maturity of this particular bond? Now one thing we know for sure is that it is not 8%. The coupon is 8%. And if the bond was trading today for $100, then the yield to maturity would exactly equal the coupon rate. But the bond is not trading for $100, it's trading for $92. Therefore, the yield to maturity must be greater than 8%. Well, how do we calculate the yield to maturity? We use the exact same method that I described. We have cash flows, we have 20 different cash flows, and 19 of them are equal to $8, and the very last one is equal to 108, the coupon plus the principal of the bond. We've got a price today of 92. What is the discount rate that will make all of those cash flows coming in the future exactly equal to 92? Now, we might start with 8% and figure out the value of all those cash flows at 8%, and it turns out that 8% would deliver exactly $100, which is too high. It's higher than 92. Then we could try 9% and see what happens in terms of the value of the cash flows, and perhaps that would equal $88, which is too low. So then we could try 9.4% and iterate until we get to the bond value, which is 92. So what we can do is to calculate the yield to maturity on a bond, and it represents the investment rate of return if we hold the bond for the life of the project, which is in our case 20 years. The same thing is true for a project evaluation. So the project might not be 20 years, it might be 5 years. We've got cash flows that are coming in through the life of the project, and there's some initial cost to the project. We can actually go and find the discount rate that exactly makes the present value of the cash flows coming in exactly equal to the cost. And that's the internal rate of return. Now, the usual rule in using internal rate of return is that the firm has some cost of equity that's relevant for this project. And remember, we're always assuming that the project has the identical risk as the firm. So suppose the firm's cost of equity is 12%. And suppose that the project that we're looking at has an internal rate of return of 13%. Then we would accept the project because it is delivering an investment return greater than 12%. It seems like a very reasonable rule, and you might question as to why we might prefer not to use it. And let me tell you why. First thing is that if we've got a project that delivers an internal rate of return of 13%, it has a positive net present value. So if we're using net present value, we would accept this project. Now, there's certain problems with the internal rate of return, especially when we're evaluating multiple projects. For example, it might be that one project has an internal rate of return of 13%, another project has an internal rate of return of 15%. And if you can only choose one project, by the internal rate of return rule, you would choose the 15%. However, this could be the wrong choice, because the internal rate of return ignores the scale of the project. So it might be that the 15% project is a very small project, and the additional value that it generates for the firm is very limited. But the 13% project could be a massive project that delivers a lot of positive net present value. So internal rate of return ignores the scale of the project, and for mutually exclusive projects, this poses a serious problem. Now, there's some other problems in using the internal rate of return. For example, the internal rate of return could be problematic in that the way that you solve for the internal rate of return might produce more than one solution. And when you go through the lecture note, you'll see some examples where multiple solutions are provided. So it might be that you get a solution of 10% and a solution of 90% in terms of the internal rate of return. You could have two solutions. And which one do you use? And this often happens if we've got cash flows that have alternating signs. So a positive cash flow in year 1, but a negative cash flow in year 2, and a positive in year 3. We can even run into the problem, and this is a very serious problem, that when we solve for the internal rate of return, that the solution is an imaginary solution, a complex number. And of course, this does not make much sense when you're trying to evaluate a project to present some evaluation criteria in the complex plane. So the internal rate of return has that problem also. Well, there's a number of other problems that I detail in the lecture note. There's a problem if there's a non-uniform term structure. And this means that the rate of return that we require for 1 year out might be different than 2 years out. The internal rate of return basically assumes that all of the rates are the same throughout the project's life, and this could create a problem.